Good evening. Welcome back to Hurdle Rate. For this video, we are going to build a DCF model for PayPal, the payment processing firm. So, as we can see, for the last year or so, the share price it hasn't really been that exciting. It had this peak of in the 90s and the low of what's that 50, 55, 56-ish after the tariffs, and now it's settling around the 70s. It did have a jump when it posted an earnings beat a few days ago, but then that seems to have retracted. So let's build the model and see what it says. So as always, open up your spreadsheet, go page layout, remove the grid lines, go view, freeze the first column, insert another one in front of the A, make A smaller, make B larger. We go ticker, we want the date. And in A1, actually, just put PYPL and go data, stocks. Have it, let it load. This one listed on the NASDAQ. So why is it taking all of these down a bit? Go. I'm going to zoom in a bit for you. Yeah, there we go. Current, implied. Then we want to know if there's any up or downside. We'll put this lightish beige on, put a border. What we need. Copy this over. There we go. So the ticker, we go equals A1 dot ticker. The date today is the 31st of the 10th, 2025. The current price equals A1 dot open parentheses or the brackets price. Go. Leave these two for now because we don't know them yet. They will come from building the model. Put an X in here, come home, enter it, then select up to about N. Go fill, use this navy. There we go. It's sort of the PayPal colors. So yeah, revenue segment. We'll come on to pulling the statements up in a second, which is bare, base, full. Okay. So go onto the SEC website, type in PayPal, just put the ticker PYPL, pull it up, and select the most recent 10Q, which was on the 28th of October. Pull that up, and then also if you scroll further down, we can get the most recent 10K as well. I've already opened them up. There it is. It was released on the 4th of February 2020. So yeah, this is the one I want. Net revenues come down to page 35 on the 13 on the 10Q. So PayPal breaks down its revenues into two segments. Transaction revenues, and these are net transaction fees charged to merchants and consumers on a transaction basis based on the TPV. And let's just see what the total processing volume, I imagine. Yeah, TPV is the value of payments net of payment reversals successfully completed on our payments platform or enabled by PayPal via a partner payment solution, not included in gateway exclusive transactions. Okay, so yeah, so is net transaction fees charged to merchants and consumers. You obviously, I'm sure you've all interacted with PayPal in some manner. So yeah, that's the fee they take to process the transaction. Then revenues from other value-added services. Net revenues derived primarily from revenue earned through partnership, referral fees, subscription fees, gateway fees and other services we provide to our customers. So yeah, that's, I guess, how would you, yeah, right. Okay, yeah. So for example, like the subscription fees, whenever you sign up to something, it'd be like I guess an online, one of the online newspapers, etc. You pay your subscription fee, and that's how that's PayPal offers that service to process those fees. So yeah, so it's in those two segments. One, obviously, transaction revenue is significantly higher than the other one, but it's, I mean, yeah, it's like I was going to say the last couple of years, well, for 23 and 24, the revenues from other was fairly stable. I guess to be honest, there hasn't really been that much growth in PayPal revenue, when really you thought they would, because you see its rival, say like a Stripe, showing significant growth. Yeah, all this other, which is copy this down and below. So we want the operating income, that's called the EBIT, the earnings before interest and tax. Then we want the weighted average cost of capital, that's the WACC, and then the terminal growth value. This is once at the end of our forecast, so we're forecasting 5 years out until 2030. After that, we're going to say the company will grow at a terminal growth value. Usually we put that about 2.5%. So all of these equal to 2, except the bottom 2. Leave these for now. Sorry, this is the revenue build. So equals transaction revenues. And below that, we want to know what the growth rate is for this revenue segment. We want the bear, base, and the bull. Then those slightly up here and put percentage of revenue. That one isn't that important here, especially as it's only two revenue segments. We can quite clearly see which one is the or what the breakdown is. So start in 2022, go equals 2022, well, the cell plus 1, copy it all the way to the end. Oh, no, that's gone too far. We only want 2030, so just delete those. Yeah, okay, I'll zoom in a bit more. There we go. So let's just format number. We don't want any decimal places. We want to use the thousand separator. So just put a comma when it gets to a thousand on the thing, and use negative numbers in brackets. So 2022, they did 25,206, 26,857, then 28,842 in 2025. So we want these figures here. 2024, we do the total figure divided by the 9-month figure, divided by 21,254. And this gives us a multiplier, which we can go 21979 multiplied by 1.357,01515. Again, it doesn't have to be that precise, but to work out the growth rate, you just take the year that you're looking at, divided by the previous year minus 1, convert that into a percentage. Copy it across. There we have it. Now, what we want to do is we want to forecast the sales growth, so the where we think it's going to go. And for that, let's use as the final year what we're going to put in 2030. We will put, let's say 10%, because they did announce a partnership with OpenAI, which, I mean, it should be quite, it should lead to revenue growth. Yeah, so we'll take an average of the last 3 years. That gives us about 6%. Just make this format go to percentage, 2 decimal places. It's good. Now, to work out these three, all we do is we go equals, you take the previous year, minus, open brackets, the previous year again, subtract, the final year, close brackets, divided, okay, the final year, 2030, minus the previous year, 6. Now, we want to just copy and paste this onto the next to down here. So the way we're going to do that is we're going to lock in certain parts of this so that it can dynamically adjust to what we need it to do. So for this one, we don't need to. We want this to adjust completely down to down as it goes lower, but also as it's pulled across. So it's only this one, the K25, we want to lock in the K, so the column, but not the row. For this one, we want it to be permanent, the K20 up here. We want that to be permanent. So we say $1 before the K and $1 before the 20. And that locks it in. That means that will always be used in every calculation when we copy it. For this one, we want the row to adjust, but not the sorry, we want the column to adjust, but not the row. So we just lock in the 20. So equals, copy, paste that along, then we have it. So if we say a bear case will go 90% of this 10%, so it would be 9% growth. And for this one, we'll say 1110. That's the optimistic side. So to work out the growth rate, the bear case, we take the base multiplied by the bear case scenario, lock that in, just pull it across. Then we do the same for the bull. We take the base multiplied by here. We lock that in, pull it across. And the goal, the reason we have the bear, base, and bull case scenario is we want to simulate between using these switches. We change it to 1, to 2, to 3 to signify the different scenarios. Bear being the 1 and the base being 2 and the bull being 3. So the way we can flick between those on the spreadsheet is we go equal, we use the offset function, and the reference is the cell that we're in right now, G23. The rows are, we go C10, which is our switch, and lock this in because it's going to be the same for the whole row, and then comma, and we just go 0. There we have it. Pull that across. And let's just work out the forecasted revenues. To do that, you take the previous year multiplied by 1 plus the growth rate, close brackets. Let's pull those across. Now I'm going to show you how the switches work. Remember these figures, 31 billion, 33, 36, 39, 43. Let's go to a bear case scenario. See it changed? Come back to base. Go to the bull. See, 45 billion instead of 43, the bull. Okay. Now, let's copy this. Pull it down here. Back to the 10K. And let's start updating. So 2312, 2914, 2955. For 2025, let's see, because this isn't great growth that when you consider 26% in 23, for it to then just go down to 1% the following year growth is not great. So by the first 9 months, they had done 2177 divided by 2177. We get a multiplier of 1.357. So if we say 2517 multiplied by 1.35737,253, so we're getting a very good growth for 2025. It should be 16% higher than the previous year, which is very positive. And again, we would want to see double-digit growth, ideally in the teens. But let's say it settles at about, I think let's give this 15% equals the 11. Okay. Now all we have to do is we don't have to go through the same building, writing the whole thing out again. We just need to update the we just need to update it so it corresponds with the correct row. That along. There we go. So these are our forecasted revenues for the other part. For a border, I think the other includes things like their buy now, pay later as well, which obviously, if you look at, I mean, it's been quite volatile for things like, I guess, Klarna, they've had stratospheric growth, but then also revenue has collapses as well. So it's quite volatile there. There goes sum, and I guess you imagine that's going to be the same for PayPal. Equals sum. There we go. Fold it, pull it along. Get the revenue growth, just copy that, pull it down, and it should give you what we need. Yeah, that looks good. If you want to know what the percentage of revenue, all you do is you just go transaction revenues divided by the total revenue. You do the same for the other segment. Okay, yeah, that looks that's good. That's the revenue build done. Let's move on to the income statement. So we start with revenue. We just pull down what we've got from here, put it across. EBIT. Want to see percentage of revenue. So below that, we want taxes. Percentage of EBIT. Okay, so what do we want to? Operating income down here. But we want to start with the 10K year usually puts the income statement, the full statement at the end. That's the balance sheet. Here we are. Operating income. So 3837. I got that right? Yeah. 3837. 3837, then 5411, 5329, 5. So if in, what was that? In 2024, it did 5 billion in EBIT. divided by 3884. 1.7, do 4554 multiplied by 1.37203913. Okay, so this is looking very good. The EBIT margin seems to be growing. It was a few years ago 14%. I'm not too sure why that was the case, but we'll look into we'll have a quick look at the statement. So just take an average of the last few years, then go. This one is just a placeholder, so we don't have to worry about it too much. Back to the other one, we'll have a quick glance at what took it down. So anything that was really big. Technology, so R&D. I mean, there wasn't really anything that I guess it was probably it needed better revenue growth. Okay, so 947. What this is? Oh, EBIT. So the tax rate's about 25. 1165. 1182. Mm-hmm. Where is it? Yeah, that looks good. Divided by 893. 861. 2. Lower. Pull that across. You just take your EBIT multiplied by the tax rate. Go. Down now, we want the cash flow items. And this is the depreciation and amortization, your capex, and all of and the change in net working capital. So that is, yeah, we just go depreciation and amortization. We want to know what that is as a percentage of revenue. Also, as a percentage of X, then we want to know the capex, capital expenditures. We also need to know what this is as a percentage of revenue. We want the change in net working capital also. Okay, so on the 10K, this is page 61. We want this line here. 1317. A bit of formatting. 1317, 1072, 1032. The percentage of revenue, this is capex, this one, purchases of property and equipment, 706, 3, 683. Again, we want to know the percentage of revenue. The capex is significantly lower than the depreciation and amortization, which is great for free cash flow. But it's probably not great long term because you allow everything to deteriorate if you're not replacing it fast enough. Okay, changes in assets and liabilities. It's just the sum of these. This is the change in net working capital. You sum all of these here, these 5 lines. So we go sum minus 163. Remember in the brackets, it means negative. Minus 1230, 118, minus 35,856. And again, when this figure is negative, it's good for free cash flow, and I'll explain why that is the case. Change in net working capital. Where are we? Yeah. Equals again sum minus 114, minus 118, 203, 7, minus 222. For sum 85 minus 1131, 8, 3, 4, 3. Okay, let's work on this percentage of revenue, very small. Yeah, one's here. 11, 6, 1, 5, 4. Sorry, no, I've done that in the wrong place. Okay, now the depreciation and amortization. Let's go back to divided by 783. 8, 4, 7. CapEx again. So do 68. Just do this divided by 480. Okay, so it will be quite a bit larger this year. It multiplied by 1, or 2292. Okay, so now it's sort of coming in line with the depreciation. They won't actually be that good for free cash flow. They'll cancel each other out. So take an average from the last 3 years and forecast it out, and then take your revenue and multiply it by the percentage of revenue. Pull that across. We also want to know what this is as a percentage of the capex, the DNA divided by the capex. Cross. Don't worry about those errors. We're going to solve them in a second. Go. Average of change in net working capital by. There we go. Okay, now the next section is the DCF. Copy the section header. DCF. Go revenue. Make it equal. Always make it equal to what we have already done, unless we say otherwise. It's just that we want the whole thing to be dynamic. Otherwise, like when we get at the very bottom of this, and we get the share price and the forecasting the free cash flow, we need it all to be linked so that when we go through the simulations or when we update the revenue build, it will update automatically. So EBIT now. EBIT percentage of revenue. Yeah. And just pull this, copy it, but just up to 2025, because we're going to do a bull, base, and bear case scenario. Down. Yeah, so it's going to average, and let's say that eventually the EBIT comes back up to 19%. I think that is what is being forecasted. So actually, some are even saying 21%. So let's say 20%, and we go 95 on the bear and 105 on the bull. So what's that? G13. Change this to 13. Put it across. So yeah, we're forecasting an EBIT margin between 19 and 21%. Now equals offset. The cell that we're in, G69, G13, but let's lock it in. Pull that across. Now the EBIT forecast, you just take the revenue multiplied by the percentage of revenue. Pull that across. For the taxes, we want the percentage of EBIT, but we want to make it equal to what we have up here. And then pull that, but only up to 25. Get it as a percentage of EBIT. Pull that across. Now, take an average of the last 3 years. I know we did the same above, but pull that out. But to calculate the forecasted taxes, we're just going to go equals. We're going to take this EBIT that we can simulate with a bear, base, and bull, and then multiply by the tax rate. This way, the tax rate, the taxes paid, adjusts as and when we play with the switch on the EBIT. If you want to see that, we can. It's on base now. Remember 6351 1315. Change it to, let's go bull. 6668 1351. That's what we want. We want it to be dynamically changing as we're simulating different scenarios. Now, just put a border here. This one, the thick line. Pull that down. Go. This is the EBIT, the earnings before interest, but after tax. And all that is, starting 2026, take your EBIT, your projected EBIT, and minus the tax. Bold it, pull it across, and there we have it. Now below, let's put DNA, CapEx, and change in net working capital. Put these into bold, pull it down from, this is quite straightforward, just pull it down from up here. This is, again, pull it across. Yeah, can you see? Go. And now we can calculate our unlevered free cash flow. So pull it out. We want unlevered free cash flow. Now, to calculate the unlevered free cash flow, you take your EBIT, you add back in depreciation and amortization because it's a non-cash expense. You subtract your CapEx and you subtract your change in net working capital. And because the change in net working capital is negative, two negatives make a positive. So it'd be like adding it back in. So this is very positive for free cash flow. So let's take our EBIT plus add back in the depreciation minus the CapEx minus the change in net working capital. That gives us 6.6 billion in unlevered free cash flow forecasted. Okay, so that's our unlevered free cash flow forecasted. We want to know, we forecasted these out 5 years into the future. We now want to work out what the present value of each of these generated. So that's the present value of unlevered free cash flow. But to do that, we need to calculate our WACC, our weighted average cost of capital. So come on to another sheet. And again, go page layout, grid lines. You don't have to freeze the top of them, but just make it a bit smaller. In the top, go PYPL. I'm going to zoom in a bit as well. Go data, stocks, PayPal holdings. Okay, so what is the weighted average cost of capital? It's known as the WACC. And that is your percentage of, well, I'll tell you what it is first. This is it's the risks to the cash flow, so it's a discount rate. And the way it's defined, it's the percentage of equity multiplied by the cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus the tax rate. So we go market cap. So to get all of these, we need a few components. And the first one we'll start with is the market cap. Then we want the percentage of equity, which is the market cap plus debt, which to get a total, and then you do the market cap divided by the total. And the cost of debt. And the cost of debt is made up of the risk-free rate, the beta, and the equity risk premium. Just indent these slightly because they're their own calculation, really. Okay, debt, cost of debt, no, sorry, percentage of debt. Tax rate, total, and we have WACC. So we have all of these that we need to work out. Okay, so the market cap is easy. We just go A1.open market cap. Sorry, I will undo that again. Make sure to divide by 1 million. Going too quick. Divide by 1 million because this, our model is denoted in millions. There we go. So the market cap of PayPal is about $65 billion. $65 billion. The debt we find on the balance sheet. Yeah, up here. So first of all, we come to liabilities. Next, we go through current liabilities. Let's see if there's any short-term debt. There isn't, but the long-term debt, 11,276. 11,276. Just do it like that. Go total. There we go. So the total is 76 billion, which means we know the percentage of debt now is the same for the market cap divided by the total, 85%. Sorry, this is the cost of equity. What am I doing? Cost of debt. The way we'll do that is we take our interest expense here. No, it doesn't say. Normally there's a line saying interest expense. That does not seem to be because it is down. But this is the repayment of the debt, not the interest on it. It will go for this one, 210. Do equals 210 divided by 3 multiplied by 4, because we're what do you call it? We're 9 months into the year. So if we divide it by 3, we get 1 quarter. Multiplied by 4, we get the full year. So 280. We want the cost of debt, we're going to say, is 280 80 divided by the total debt. And that is about 2%. The tax rate should be down here somewhere. Page forward. Is income taxes. Look at income tax. Yeah, found it here. 19%. Okay. Now we need to go on to the cost of equity. We've got all the other components. It's just this one here that we need to build out. And this requires a bit more effort. The risk-free rate is straightforward. We go and we take the US 10-year, which is 4.095% at the moment. Let me just refresh to make sure that is the case. Bonds, 4.095%. 4.095%. And the beta is, we're going to say, okay, so to do this, we need, actually, we don't really need to go into that much, because I think there's really only one operating segment for PayPal. It is, sorry, I'll pull this up onto here. It is something financial services non-bank. So we can just take this, the average unlevered beta is 0.27. Yeah, that's going to be the full weight. So we'll just go with that 0.27. In another video, I'll show you when we have different parts of the when there's different businesses within the company, and they have different betas, and then we merge it together. I'll show you that in another video. For this one, let's go with this one 0.27 because it's not a there's only one business unit for it. But the equity risk premium, we know this because we can see where the breakdown of revenues are from. What page did I say? Page 13, didn't I? This is what we want. So for the US, let's go region. We've got US other. We want to know the revenues, the ERP, the weight, and then the weighted ERP. So just bold this. So the revenues for the US, we'll just use the 9-month years. We don't have to annualize this. $13.95 and 10,571. The ERP, let's pull up the spreadsheet. So we know the ERP for the US is 4.61%. And what we're going to do now we are going to just delete this one. We get a global ERP of about 6.4%. And that is our rest of the world excluding the US. 6.41%. And I know we're sort of including Canada there, but when we're in North America, I know we're including Canada and North America, but it's okay. This is fine. So go equals sum. The weight, so the US is more than 50% of revenues. Do the same for other. Now the weighted ERP is, you take the ERP multiplied by the weight. Put it back to 10. Go. 5.39, so almost done. Okay, now we can calculate the WACC. We go equals, we take our percentage of equity multiplied by our, oh, sorry, I haven't even done the cost of equity yet. Apologies. So your cost of equity equals your risk-free rate plus your beta multiplied by your equity risk premium. And that you take your risk-free rate plus your beta multiplied by your equity risk premium. Hide. There we go. Okay. Now the WACC is you take your percentage of equity multiplied by your cost of equity. Put these in brackets. Plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. You have it as your WACC. Yes. Go 5.03%. D9 page. So we come back onto the other page. We go equals. Just put it equal to what we've just calculated. There we go. And we'll put a bearish scenario of plus 0.5%. There. This is not G. Go. So the more bullish you are, the lower the WACC, and the more bearish you are, the higher the WACC. So terminal growth value, we're going to put at 2.5%. And a bear case, we're going to do minus 0.5%. And a bullish, we're going to do add, because the growth rate would be higher. And again, we want to have our switches so we can flick between all of these. But instead of using offset, we're going to use choose. And just select all of these, but make sure in the order that you can see them here. Close brackets. Go. Now, let's calculate our share price. So come back down to here. The present value of unlevered free cash flow is you take your unlevered free cash flow, you divide it by 1 plus the WACC, close brackets, to the power of, oh, I've forgotten to put, so just put here for now, lock in the WACC, just put a 1 above 2026. Yeah. Pull that across. There we have it, the unlevered free cash flow. So this is in the first year to the power 1, second year to the power 2, to the power 3, to the power 4, to the power 5. Following the free cash flow, we want to know what the terminal value of the company is now. This, we take the final value of cash flows, multiply it by 1 plus the terminal growth value, close brackets, divided by the WACC minus the terminal growth value. Load. Wow, it has a terminal growth. They're saying that this could be a $400 billion company. But it's a very low WACC and it is producing decent cash flows. But let's do a bit more digging first before we get too excited. Then we want the present value, the PV of TV. You take this number divided by 1 plus the WACC to the power 5. This is actually going to be like really undervalued. This will be really undervalued. Okay, enterprise value is next. And we know the market cap is what is it, 65 billion, and the terminal value is 400 and something. But let's keep going. We want to, the enterprise value is the sum of the present value of the terminal value plus all of the present value of the free cash flow is forecasted. So we go sum. Go. For the enterprise value now, we want to add the cash back in, and you subtract the debt to get the equity value. From the equity value, we then divide it by the diluted shares outstanding to get the implied share price. But let's not jump ahead of ourselves. We want the cash, so we need to come back to the balance sheet. At the top, we go. We want these two here. Equals 8995 plus 1760. We want to take the debt, which we know from the WACC. So the equity value is you take your enterprise value, you add back in the cash, you subtract the debt. The diluted shares outstanding are down here, 96978. So the implied share price is you take your equity value divided by, it's saying 367, which, let's plug it in, A100. Calculate the upside or downside. You do the current, the implied minus the current, minus 1. I mean, there's, if this is true, yeah, there's a significant upside to PayPal. Let's have a quick glance. Are we being too optimistic? So, I mean, in 5 years, you're saying it's going to go from 33 billion to 50 billion. Maybe let's temper that. Let's say 5%. This one, I think, yeah, let's come down to 10. But it's the EBIT that this is really getting, because we're saying that it's going to have really big EBIT margin expansion. And that's what the, I guess, consensus is that they should be aiming for this between 19 and 21% EBIT growth. Yeah, I mean, it wasn't long ago that PayPal was forecast to be, well, it was trading at something like $350, $360, $370 a share. But let's come back to what we initially forecasted. We said 366. And if we come back onto our chart and we go 5 years back onto a weekly candle, this peak up here, a bit. Okay, so it was about 320. Yeah, let's go back to this being 5% and it's coming to 10, and we keep that, and it comes similar to what it was trading a few years ago before it crashed quite badly. So I mean, maybe we can look in and maybe the WACC we're a bit too generous here, saying it's only at 5.4%. But I mean, yeah, I mean that's what it's come out as. So yeah, I guess that's it. If you've got any comments, please do leave them in the comment section, and please do hit subscribe. And I'll see you on the next one. Thanks again for watching. Bye.